The live stock price for Seagate Technology Holdings PLC at this moment on Wednesday, January 28, 2026 is $447.99 USD, marking a massive intraday surge of $76.23 or approximately 20.51%. This is not just a standard move, it is a violent upward re-rating that has caught the broader market off guard, especially given the sheer scale of the vertical climb since the opening bell. While the general sentiment around storage has been positive for months, the reality of today's price action suggests something far more aggressive than a simple earnings beat. The immediate surprise here isn't just that Seagate beat expectations, but that they did so while maintaining record-breaking gross margins of 42.2%. For a hardware manufacturer often lumped in with cyclical commodity players, hitting these kinds of numbers is practically unheard of. If you're looking at your Robinhood app or checking your Fidelity brokerage account right now, you're seeing a company that has effectively decoupled from the traditional race-to-the-bottom pricing that plagued the hard drive industry for decades. The expectation was that as storage density increased, price per terabyte would fall fast enough to eat the profits. The reality is that Seagate has managed to tighten the supply of high-capacity drives so effectively that they are now commanding premium pricing in a market that literally cannot get enough of their hardware. We need to talk about why this matters for the broader tech landscape. When we look at Apple stock or Nvidia stock, we often think about the processing power and the consumer interface, but the massive, silent foundation of the current artificial intelligence build-out is data storage. You cannot train a model or run an inference engine without a place to put the trillions of parameters and the massive data sets that feed them. Seagate is no longer just selling disks, they're selling the physical real estate of the digital world. The market is finally waking up to the fact that while everyone was focused on the chips, the shelves to hold all that data were running empty. Common knowledge in the investment community suggested that Seagate would be a slow and steady dividend play, perhaps a good fit for Schwab Intelligent Portfolios or a conservative individual brokerage strategy. The deeper truth revealed today is that Seagate has transitioned into a high-growth infrastructure play. They reported fiscal second quarter earnings of $3.11 per share, blowing past the $2.83 the street was looking for. Revenue hit $2.83 billion, which is a 22% increase year over year. But the real kicker, the part that is forcing analysts at Goldman Sachs and Morgan Stanley to scramble, is the guidance. Seagate is looking at $3.40 in earnings for the next quarter. This isn't a one-off spike, it's a sustained upward shift in the baseline of their profitability. The institutional activity today is frantic. We are seeing massive volume, over 10 times the normal daily average in just the first few hours of trading. This looks like a classic short squeeze mixed with a fundamental reevaluation. Roughly 6% of the float was sold short going into this report. When you have that much bearish pressure meeting a 20% gap up, those shorts have to buy back their positions at any price, which only fuels the fire. Major funds within the Fidelity wealth management ecosystem and various Fidelity ETFs have been increasing their weightings in Seagate for the last 2 quarters, and today that patience is paying off. Interactive brokers and other professional-grade platforms are seeing heavy call option activity, particularly at the 490 strike, suggesting that some traders think this rally has even more room to run. Let's look at the actual mechanics of what happened in the last few hours. The stock opened at 395.19, already a significant gap up from yesterday's close, but it never looked back. It touched a record high of 448.69. This isn't just about Seagate, it's lifting the entire sector. If you're involved in online investing, you've likely noticed Western Digital and Micron moving in sympathy. However, Seagate's specific focus on heat-assisted magnetic recording, or HAM technology, is what sets them apart. They're shipping 32 terabyte drives while competitors are still trying to stabilize their 24 terabyte offerings. In the world of massive data centers operated by giants like Microsoft and Google, that density is everything. It means more data in the same physical footprint, using less power per terabyte. The institutional ownership of Seagate is incredibly high, sitting at nearly 93%. This means that the smart money has been sitting on these shares waiting for this exact moment. When a company has that much institutional backing, the retail crowd often misses the initial move. If you're using investing sites to find the next big thing, you might have overlooked Seagate because it seemed old tech. Today's movement proves that in the tech world, the old can become new very quickly when it becomes the bottleneck for a massive technological shift. This is a supply-side story. Seagate has spent years consolidating its manufacturing and cutting out the fat. Now that demand has exploded, they have a lean, highly efficient machine that prints cash with every exabyte shipped. Speaking of exabytes, they shipped 190 of them this quarter alone. That is a staggering amount of storage. Now, I want to hear from you. Comment below how many shares of STX you're holding, or if you think this price jump is sustainable given the current economic climate. Are you a long-term holder, or are you looking to take profits at these record levels? Let's get a discussion going in the comments about whether you prefer Seagate or Western Digital for the long haul. When we look at the business model, Seagate's transition to a build-to-order pipeline is a masterstroke in risk management. In the past, they would overproduce, leading to inventory gluts that crashed prices. Now, they have long-term agreements with major cloud providers that extend through 2027. They aren't building drives hoping someone buys them, they're building drives that are already sold. This provides a level of visibility into future revenue that is rare in the hardware space. It's the kind of stability that makes it a top holding in things like the iShares Select Dividend ETF or various Fidelity mutual funds focused on tech and income. The historical context here is important. For a long time, Seagate was seen as a legacy player struggling against the rise of solid-state drives, or SSDs. The narrative was that hard drives were dead. The reality, as we see today, is that while SSDs won the battle for your laptop and your phone, hard drives have won the war for the data center. The cost difference is still too high for SSDs to replace HDDs at the exabyte scale. Seagate leaned into this, ignoring the consumer market to focus almost entirely on the cloud. That focus is now their greatest strength. They've retired roughly $500 million of debt recently, cleaning up the balance sheet and giving them the flexibility to raise dividends or buy back more shares. Looking at the technicals, the stock is currently riding far above its 50-day and 200-day moving averages. Some might say it's overextended, and a pullback to the 410 or 420 range wouldn't be surprising as traders digest these gains. But when you have price targets being hiked from $340 to $500 by firms like TD Cowen, the momentum is hard to ignore. This is a fundamental shift in how the market values the company's earning power. They are no longer trading at a low multiple because of cyclical risk. They are starting to get the premium multiple associated with AI infrastructure providers. The macroeconomic pressures are still there, of course. Interest rates and global trade tensions remain a factor for any company with a global supply chain. But Seagate's manufacturing base in Singapore and other parts of Asia is well established and highly optimized. They've managed to navigate the last few years of supply chain chaos better than most. If you're looking for investment help or trying to navigate self-investing through a SoFi active investing account, Seagate represents a unique intersection of value and growth. It's a company that was priced for mediocrity, but is delivering excellence. For those of you using SoFi Invest or Interactive Brokers to manage your individual brokerage, the key takeaway today is that the boring parts of the tech stack are often where the most significant opportunities lie. While everyone is chasing the next software startup, the companies building the actual physical backbone of the internet are the ones with the real staying power. Seagate's free cash flow of $607 million this quarter, the highest in 8 years, is proof that their strategy is working. They aren't just growing, they're growing profitably and returning that value to shareholders. In the coming months, keep an eye on the Mosaic 4+ ham qualifications. If they can get those drives into the hands of more cloud providers ahead of schedule, we could see another leg up. The company has already allocated almost all of its capacity through the end of 2026. That kind of demand is essentially a sold-out sign for the next 2 years. In a world where data is being created at an exponential rate, being the person who owns the vault is a very good position to be in. The broader market for online investing has become increasingly complex, with so many options from Robinhood crypto to Fidelity IRAs. But the core principles of investing remain the same. Look for companies with a competitive moat, disciplined management, and a product that the world can't live without. Today, Seagate